Welcome to Forex 101. Getting started, we are going to jump into currency futures. All right, so currency futures, they're interesting. I usually get, a dozen or so questions about currency futures throughout the year. So we always like to say, hey, you know what? If 12 people are asking us about it, there's probably 30 people out there that didn't find the time or didn't have the total curiosity to ask us about it, or they just went out and researched it on their own. So we figured whenever we get a lot of questions on something, we just make a video because we figure a lot of people are wondering about it. So let's jump into currency futures and let's really get started with futures in general. So futures trading it's always happened, but it hasn't happened on regulated exchanges. And the best way for me to go through what a futures contract is, let's take a farmer who grows corn. Now, a farmer that grows corn, they have to start doing all their work in the spring. They have to, again, and I'm going to act like I know what farmers do. If you're a farmer, please understand I'm literally making all this up, so don't hold that against me. I also do the same thing when I give hunting analogies. I give hunting analogies as well, and I've never hunted, so this is all of what I picture farming and hunting being. But anyway, the farmer, they've got to cultivate the land, they've got to plant the seed, they got to take care of it, and they have no way of knowing at the end of the year if they're going to make any money, because they don't know what the corn prices are going to be after the harvest, and that's really all they care about. And they know that they're going to have all these costs that go into growing corn, and it might cost them $3 a bushel to grow corn. And then they grow that corn, and then at the end of the year they go to market and corn is only trading for $2 a bushel. Well, that's really tough, because now you take a loss that year and then you've got to go to next year and try to make it back with having no expectation. Now let's take a company like Kellogg, who buys a whole lot of corn to make cornflakes. And Kellogg's knows that when they sell a box on the store shelf, they know they have to buy corn for a certain amount for them to be profitable. And the volatility of corn prices can really hurt them. So what they want to do is they want to secure as much corn at a good price in advance as they possibly can, because they need to have corn to continually make progress. So the farmer and Kellogg's get together and they say, hey, look, how about we have an agreed upon price that in the fall you pay me $4 per bushel? That is a futures contract. They agreed upon a price and they agreed upon a date. Now, during that time, corn prices could go wild. The corn prices could go up to $8. And at the time of the contract, Kellogg's was really happy they locked in $4, because if not, they would have to pay the open market rate of $8. Now, look, the farmer's bummed, but guess what? He was guaranteed a profit. He was guaranteed to make a profit that year, which he was just fine with. But let's say there's a glut of corn on the market and the prices go down to $1.50. Well, the farmer is really happy that they sold that contract to Kellogg's, because Kellogg's has to pay them $4. So futures contracts have been around forever. It's just been, I want to say, in the 1910s or 20s that they actually made formal exchanges where you could actually trade these. And the formal exchanges, they were all over regionally, but the biggest one was Chicago, and now Chicago has pretty much bought everything up. And the CME, the Chicago Mercantile Exchange, pretty much runs all the futures contracts. So years ago, somebody said, hey, let's do currency futures in 1972. So they put together the contracts, and now you can trade currencies through a futures contract. This market is not as big as the spot market. It's $700+ billion per day in trading volume. Just in relation to the spot FX market that we trade, it's over $5 trillion. So as you can see here, not quite as big of a market, mostly used for hedging. Now, the way a futures currency works, we're going to get into it, but you're going to hear things like the pound futures, the euro futures, the yen futures. You're going to hear that all the time. What you need to think of is versus dollar. So when someone says euro futures, it's euro versus dollar. When you hear pound futures, it's pound versus dollar. Everything is against the US dollar. So the euro futures are going to be the same thing as the euro US dollar in spot Forex. All futures are trading contracts. So again, the smallest one you can buy is one contract. One contract. And we'll get into that in just a second. And then all futures have a delivery date, where basically the trade is over. So if you were to buy the January futures in the third Friday of January, I think it's, third Thursday in January, that will expire. And everything is settled up on that date. So as I said, the CME group is the main group, and the CME group is the only group that trades currency futures. So let's talk about futures. The currency futures are going to follow the same rules. The futures are not open 24 hours a day. They're open 22 hours and 45 minutes a day. All right. We're going to get closes. Everything opens up on Sunday at 6 p.m. and closes on Friday at 5 p.m. But every day from 4:15 to 4:30, there is a little break, just a little break, a little trading halt. Now, these are just old school draconian rules because this is now done pretty much all electronically. Yes, there are still some open outcry, but basically they did this so the traders on the floor could take breaks. Obviously during the day it's very hectic, and then they would take a break right at the end of trading at 4:15, and just take a breather for 15 minutes. And then they would shut down when the New York banks closed, and that's when they did all of the record keeping. So if you've watched a show like Trading Places, that's literally was the futures trading pits, where they were writing on tickets, and they would take all the tickets to the clerks, and the clerks would have to enter in all of the information off of the tickets. So they closed the market for that 1 hour, and then they reopened them again. They're still following those rules, and so, as I said, they are open for 22 hours and 45 minutes a day. So not quite as long as Forex, but pretty darn close to all day long. So every single time you trade any futures contract, a futures contract has what's called a multiplier, and basically is saying one contract equals X. So for example, a gold contract, I believe, equals 100 ounces of gold. That's just what it controls. S&P futures contract, it covers like $75,000 worth of the S&P 500. So every contract has what we call a multiplier, and that's how much it controls of that asset. So for example, the Euro futures have a multiplier of 125,000, meaning it's 125,000 US of that. So then you have to times it by the rate of the Euro futures, which in this example is $1.1683. So you times that, and this position size is really 146,000 US dollars. That is the position size of this trade. Now, up until about a year ago, these were pretty difficult to trade, because if you had small accounts, you definitely couldn't trade a futures contract. And if you could stretch the $1,400 per contract, that's way too big of a size. If you only had a $2,000 account and you bought one futures contract, one trade could wipe you out. And what happens is it does. It's just too big. They do now have the micro futures contracts. I think there's only micro futures available in Euro. I believe that's the only one there's micros available in. But it's basically a tenth. So it's $12,500 worth of Euro. All right, so let's just kind of take a look at just this little chart here. And this chart's just telling you, okay, this is the Australian dollar symbol 6A. Now again, 6A is the root symbol. And then it's going to have another symbol for the expiration date. we'll take a look at some charts, and you'll see 6A, and then there'll be another number or symbol there telling you the expiration date. But it's always going to start with 6A. And the Aussie dollar, the multiplier is 100,000. So as you can see here, it's always going to be 100,000. The euro is going to be 125. The yen's 125. Swiss franc is 125. And then the pound is the weird one, 62.5. There's also the dollar index futures. As we talked about in other sessions, we're just not crazy about the dollar index, the way it's put together. It's really almost just like watching euro dollar, but it definitely is a currency future that you could trade. So on the left, I've got the euro futures contracts, and on the right, I've got the euro dollar cross. Now, as you can see here, they're virtually identical. And the reason they're virtually identical is because this one is open for 22 minutes and 45 minutes, 22 hours and 45 minutes a day. This one's open for 24, or like at Interactive Brokers, 23:45, where they take a break from 5 to 5:15. So you're going to see, like, if you took a look at the Euro ETF, the FXE, it's going to have gaps all over the place because it's closed. But you can see these are going to be very, very similar to each other when you take a look at them. So trading the futures contract is very, very similar to trading the spot FX contract, or spot FX. Here we have the pound on the left, and we've got the pound dollar cross on the right. So again, pound futures, it's pound dollar. You always got to think pound dollar. All right, let's really go over this again with the dollar index. We don't like the dollar index. Yes, you can trade this dollar index, but it doesn't make a lot of sense. As you can see, a big part of it is euro. And we have a much better way to look at currency baskets. Just with technology and a quick little formula, we can build a formula where we can look at the dollar equally weighted against really whatever other currencies we want to look at. So again, like I said, the dollar futures contract is available. Again, it just doesn't make a whole lot of sense. So let's put up a little side by side here. On the left, we got spot FX. Now, spot FX is what we trade. It's what we think is the best way to trade. Again, you have actual delivery. When you make the trade, it's actual delivery. You own the currency right at that point. You have better margin requirements. You have no commissions. You have tighter spreads. And you do have to handle the currency swaps. So again, currency swap is if you hold it over 5 p.m. Eastern Standard Time, you're going to get, based on the currency, you're either going to get charged for holding that currency, or you're actually going to get a credit for holding that currency based on the interest rate differential. If we take a look at currency futures, we're buying it, but we're not getting delivery of it. We're buying a contract. All we are buying is a piece of paper. Margin rates are lower. I know Interactive Brokers are really much closer to 1 to 10. There's going to be commissions per contract, which means it makes them more expensive. And because the liquidity is less, remember we talked about spot FX has $5 trillion a day going through it. Currency futures only 700 billion. It's going to be wider spreads, which means higher costs. And then, of course, every currency contract does have carrying costs associated with it. So every day you hold that, you're going to get charged a little bit. So when you take a look at them side by side, again, we took a look at the charts. So when you take a look at the charts, you can see it's virtually the same thing. If you buy the one on the left and you buy the one on the right, it's virtually the same thing. But the big question is, okay, why do we do spot FX? Why is it better? And here I'm going to go into a couple of reasons. I just talked about how it is a more expensive trade. It's more expensive trade because of the commissions and because of the wider spreads. But this is the real big one here. Let's say that you wanted to trade pound Aussie and you wanted to do it using futures contracts. The problem is there is no pound Aussie futures contract. There's a pound dollar contract, and then there's an Aussie dollar contract. You would need to basically go long the pound futures. If you wanted to go pound Aussie, you would have to buy one contract of the pound futures. which is the multiplier times the current price. That would give you $77,000 US dollars long of pound. You would then need to make another trade where you sold one contract of Aussie futures. So basically going short Aussie dollar. And the multiplier on Aussie is 100,000 times it by the current price. It's 70,000 short. So you're not really matched up. It's close, but you're 77,000 long pound and you're 70,000 short Aussie. It's not perfectly balanced. In FX, it is or spot FX, it's perfectly balanced, and it's one trade, and it's much more simple. And plus, you're going to have to post margin for both of these trades. So you can see this trade is going to be very expensive to put on just to control one contract of each. So it doesn't make a lot of sense. So like I said, I get a lot of questions. I get a lot of questions over the years on currency futures, and I always answer them and try to be as knowledgeable and get that knowledge over. But in the end, I think everyone can see that it's just not as good of a way. So Spot FX gives you much more flexibility on position sizing. Well, what if that position was too big? What if you didn't want to do a full lot, a full 100,000 of Aussie? Too bad. Too bad. You have very little control of position sizing. What if you wanted to do 150,000 of Aussie? You can't do it. You can't do 1.5 contracts. So Spot FX, you can get to the penny. Well, I shouldn't say to the penny. You can get to the dollar. You could do a position size of 37,481. That could be your position size. You have ultimate flexibility on your position sizing. Non-US dollar currency pairs are way easier to trade. We just went through, if you want to trade pound Aussie, it's a real pain in the butt. So just the spot market, it's very simple. Costs are higher on the futures. There's an extra charge from the NFA on futures contracts. Every contract you sell, the NFA takes a little slice of it. And I will have to say that the one, again, I'm going to call this a positive even though I don't see it as positive at all. The currency futures are traded on a regulated exchange. So it is traded on the CME, and you will get centralized pricing. Now, what that means is that everyone will be looking at the same market. If you're trading pound futures, and I'm trading pound futures over in Europe, and someone else is trading pound futures in Asia, we are seeing the same price because it's on the same exchange. In the spot FX market, that is not the case. There is no central exchange. It's all based on your liquidity provider and their trading partners. So you could be in Europe and I could be here, and because we trade on different platforms with different brokers, I could be seeing different prices than you're seeing. So I guess that is the one positive about currency futures. So hopefully that helped you understand more about currency futures, and I also hope that made you say, oh, I don't need to learn any more about this. All right. So to wrap this up, currency futures, they trade 22 hours and 45 minutes a day. So almost close to it. It's very difficult to create those non-US dollar crosses. They're more expensive. But look, one of the positive things is that currency futures also have currency options attached to them. So if you are an options trader and you want to either use options for analysis or you want to use options to actually trade currencies, then you will have to go to either the currencies futures options market or go to the currency ETF options market. So again, another benefit for currency futures, they do have futures options attached to them. You can go and trade. All right, hopefully that answered all of your questions and probably answered questions you didn't even have and never wanted to have. But thanks for joining me. Everyone take care. Goodbye.